There are homes on the Gulf Coast of Florida that have been through multiple named storms and never filed a structural claim. Some are built from concrete that floats on water. Some are cast as a single continuous shell, no joints, no seams, no fasteners for the wind to find. Some have walls thick enough that a car could hit them and the wall would win. These are not experimental prototypes. They are finished homes. People live in them, raise children in them, and sleep through hurricane warnings in them because they've done the math and they like their odds. These homes file fewer insurance claims than almost any wood frame house on their street. In 2023, State Farm announced it would stop writing new homeowner policies in California. All state followed. Across Florida, insurers are exiting, restricting, and non-renewing at a rate the market has not seen since the 1990s. Citizens Property Insurance Corporation, Florida's insurer of last resort, the fallback the state created so that no one would go uninsured, is now one of the largest homeowner insurers in the entire state. It was never designed to be. In California, the Fair Plan, another last resort mechanism, is absorbing policies that the private market no longer wants. Right now, in 2026, homeowners across Florida, California, Louisiana, and the Carolinas are opening non-renewal letters. Some of them built the most disaster-resistant homes on their street, and the letter arrived anyway. If you believe homeowners deserve to know what the system is actually doing, subscribe and stay with us. This story is not over. The obvious explanation is that the insurers are leaving because the disasters are getting worse, and a stronger house doesn't change the neighborhood around it. Wildfire can jump a firebreak. A storm surge doesn't ask about your wall thickness. If enough houses in a zip code burn, the actuaries reprice the entire area and your construction type becomes irrelevant. That is partly true, and it is exactly the answer the industry wants you to stop at. Because here is what that explanation does not account for. In documented cases, homeowners with ICF construction, AAC block homes, and monolithic concrete domes have been non-renewed or repriced, not because their homes were damaged, but because their homes couldn't be categorized. The system didn't flag them as dangerous, it flagged them as unknown. And in actuarial modeling, unknown and dangerous are treated as the same thing. To understand how we got here, you have to go back to 1992. Hurricane Andrew made landfall in South Florida on August 24th of that year and destroyed or severely damaged tens of thousands of homes. The scale of the failure was not just meteorological, it was structural. Homes that should have survived the wind load did not. Inspections afterward found missing hurricane straps, substandard framing, code violations that had been built in during the construction boom of the 1980s and never caught. Andrew was not just a storm, it was an audit. Florida's response was the most significant overhaul of a state residential building code in American history. New standards for wind resistance, fastening systems, and structural continuity were written into law. Builders who wanted to go further, who wanted to build walls that couldn't be penetrated, roofs that couldn't be peeled, structures that distributed force instead of absorbing it, turned to insulated concrete forms, autoclaved aerated concrete block and monolithic dome construction. These were not fringe technologies. They were proven materials with decades of use in hurricane-prone markets outside the United States. The expectation, reasonable and logical, was that the insurance market would eventually follow the building code, build stronger, file fewer claims, pay lower premiums. That is how risk pricing is supposed to work. It did not work that way. Here is where it gets strange. To understand why, you need to know about an organization most homeowners have never heard of. The Insurance Services Office, ISO, is a data analytics company that provides the actuarial loss cost models that most state-regulated homeowners, insurers use as their pricing baseline. ISO doesn't sell policies, it sells the math. It collects claims data across the industry and uses it to tell insurers what a home in a given location, of a given construction type, is statistically likely to cost in claims over time. Insurers then load that number with their own expenses and profit margin and arrive at your premium. ISO's models are built on decades of historical claims data. That data is overwhelmingly drawn from wood frame residential construction, because wood frame residential construction is what the American housing market has been almost exclusively building for the past century. The model knows wood frame. It knows the claim rates, the repair costs, the failure modes, the frequency distribution by hurricane category and fire exposure zone. It has priced wood frame from every angle. What it has almost no data on is a home that never generates a claim. A monolithic dome that survives a Category 4 storm without structural damage does not generate a claim. An ICF home that stands while the wood frame houses on either side are stripped to their slabs does not generate a claim. An AAC block structure that survives a wildfire front while adjacent homes burn does not generate a claim. And here is the paradox that sits at the center of this entire story. No claim means no data. No data means the model cannot price the home. Cannot price means unmodeled risk. And unmodeled risk, in actuarial practice, does not get the benefit of the doubt. It gets a penalty loading factor for uncertainty. The home performed so well that it has no loss history. The model interprets that absence as a red flag. The building code said, "Build stronger." The insurance company said, "We don't know what to do with that." Every subscriber makes it harder to bury this story. Stay with us. This is the part nobody mentions. The state of Florida, after Andrew, created meaningful structural minimums in its building code. It also created a wind mitigation inspection program that allows homeowners to receive premium discounts for documented construction features. HIP, roofs, reinforced openings, rated shutters. For a homeowner who upgrades within the wood frame system, these discounts are real. For a homeowner who builds outside the system entirely, in ICF or dome construction, the discounts are modest at best. The inspection forms were not designed for structures that don't have the failure modes the form is looking for. California's Fair Plan has a different version of the same problem. It is a fire coverage backstop, not a comprehensive actuarial instrument. It was built to cover wood frame homes in fire-exposed zones when the private market wouldn't. It was not built to distinguish between a wood frame home with standard siding and a home clad in non-combustible mineral wool board over a concrete structure. The form doesn't ask. The insurer's business model is not to avoid claims. It is to accurately price and pool risk. When a home class falls outside the pricing model, the path of least resistance is not to build a new model. It is to decline to write the policy. He filed fewer claims than anyone on his block. They cancelled him anyway. Now picture this from above. An aerial shot, post-storm, a coastal neighborhood in the aftermath of a major hurricane. Blue FEMA tarps on rooftop after rooftop, bare concrete slabs where houses used to stand. Debris lines on adjacent lots, insulation, lumber, roof decking, the accumulated material of someone's life, scattered across 100 yards of Florida landscape. And in the middle of all of it, one structure with an unbroken roof line. No tarps, no damage visible from the air. The shape means the wind had no flat surface to push against. The continuous pour means there were no seams for pressure to find. Post-storm engineering surveys of these structures have found the same pattern in disaster after disaster. The concrete shells survive while everything built to the minimum standard does not. That homeowner, in documented cases, later received a notice of non-renewal. The return address was an insurance company. The reason cited was construction type classification, not damage, not claim history, construction type. The actuarial model wasn't designed to price a home that doesn't fail. Here is what you can actually do with this information. The dominant carriers, the state farms, the Allstates, the mass market admitted insurers, are not your only option and may not be your best one. The surplus lines market, which operates outside standard state rate and form filing requirements, includes Lloyd's of London syndicates and specialty carriers that have done the actuarial work on non-standard construction. Some admitted carriers in Florida and California have built experience with ICF and dome underwriting and will write competitive policies if approached correctly. These markets exist. Most homeowners, and frankly most general insurance agents, don't know how to access them. The Florida Office of Insurance Regulation and the California Department of Insurance both maintain public databases of admitted carriers and surplus lines eligibility lists. These are public records. If you are building in non-standard construction, your first call before breaking ground should be to a surplus lines broker. Not after the house is built, not after the conventional carrier has declined you before. Some ICF builders and dome contractors now maintain relationships with specialty brokers, precisely because this issue has cost too many of their clients too much money after the fact. If you want a checklist of exactly what to ask your insurer or broker before you build or buy in non-standard construction, comment the word policy below. We will get it to you. What happened after Andrew was supposed to be a reckoning. Florida tightened its code. Builders who believed in structural performance moved toward concrete. Homeowners who could afford to build the right way did. The implicit social contract was that the system would eventually catch up, that lower claims would translate into lower premiums, that the market would reward resilience, that doing the right thing would at minimum not penalize you. The system that was supposed to reward resilience built in a penalty for it instead. The insurance industry's foundational promise is simple. Take on more risk, pay more. Reduce your risk, pay less. That is the whole contract. A homeowner who builds a structure that doesn't fail should be the industry's best customer. Instead, in case after case, that homeowner has become the industry's most inconvenient one. Because his house doesn't fit in the column the model was built around. The disaster came, the house stood, the letter arrived anyway. If this story matters to you, if you think homeowners who build safer homes should not be punished for it, subscribe.